Welcome to the Miscellaneous Insurance chapter. This is a combination of personal in the beginning and commercial at the end. This chapter should go by relatively quickly, and you'll have around 10 to 15 test questions out of this chapter. The good news is it's relatively easy to understand because it's quick, short policies that you don't have to put a lot of thought into. Let's just go ahead and get started, and we'll talk about flood insurance first. Flood insurance is only sold through the National Flood Insurance Program. Even if you buy flood insurance through a private insurance company, it's still backed by the federal government's National Flood Insurance Program. When the insurance company writes it themselves, that's known as a write your own policy, but it's still through the NFIP. And the National Flood Insurance Program is administered by FEMA, the Federal Emergency Management Agency. Each year, Congress has to approve whether or not flood insurance is funded, and they usually do that around the March and April session. Flood insurance is offered to persons, businesses, cities, towns, villages. Pretty much anybody can buy flood insurance, but there's certain areas where you're required to buy flood insurance, typically through like your mortgage company or any finance company. Anytime you buy flood insurance, there is always a 30-day waiting period for any new policy. This stops people from seeing a hurricane coming and then going out real quickly to buy flood insurance. If you try to increase your coverage on a flood insurance policy, there's still a 30-day waiting period. Anytime you do anything with flood insurance, there will be this 30-day waiting period. However, if you currently own a house and have flood insurance, then you buy a new house, you wouldn't have to have the 30-day waiting period because you already had flood insurance. So you can transfer from one house to another, but you had to still have that flood insurance in place beforehand. Flood insurance has a standard deductible of $500. In the real world, deductibles can be different, but this is the standard deductible. Now, floods might seem a little weird to you. Flood is defined as the overflow of inland or tidal waters. So that's like if a river overflows and then it floods out a city, or if the ocean continues to grow through, say, a hurricane or a tsunami, and that takes out a city or town. Flood insurance is also the rapid accumulation of water or the runoff of surface water. So let's say that it's raining really hard, and the water, instead of going into the ground, it pools on the actual surface. That's the accumulation of water because it has to actually pool and build up from the ground. Runoff water is if like it rains on a mountain and then the water all comes rushing down at one time. Mudslides are considered flood, but landslides are not considered flood. The easy way to remember the difference is a mudslide has water in it. So again, it's like water raining down on a mountain and then accumulating a whole bunch of mud and debris and taking out a city. Whereas landslides don't have water. Landslides are more akin to earthquake and earthquake insurance, not really flood insurance. So mudslides, rapid accumulation of water, runoff of water, overflow of water, even erosion due to water. That would be such as a house that is on a riverbed and the water starts flooding the river, and it erodes the soil underneath your house, and then your house falls into the water. That would also be considered flood as well, but landslides, again, are not flood because there's no water involved in a landslide. If your water heater bursts, we don't consider that a flood. That is an accidental discharge. A lot of people say, oh, well, my house got flooded because my water heater burst. They can say that, but that's still not considered flood or covered by flood insurance. That's just regular homeowners insurance. Wind-blown rain, that is not flood because it hasn't accumulated yet. It's still just in the air. Wind-blown rain can cause a flood, but the wind-blown rain would then turn into accumulation of water. So wind-blown rain by itself is also not covered under flood insurance. That's just regular rain. You don't file a claim every time it rains on your house. The standard flood insurance policies provide for $250,000 of coverage for the structure of the building, $100,000 for the contents of your house. In the real world, you can buy more insurance, but we'll just say that these are standard for the test. So flood insurance has $250,000 for the structure, the building, and $100,000 contents. That's your TV, couch, stuff like that, coverage C. Now, the cool thing about flood insurance is if your stuff is in the basement, you're still not covered. If your basement floods, you're not going to be covered under flood insurance. You have to move that stuff up to at least the ground floor or above. So if a flood is coming, obviously get safe. But if you have time and you know it's coming, try and get the stuff out of your basement if you have a basement. Businesses can get higher limits, but they have to earn less than $2 million in the past 2 years. Then they fall under a different type of insurance that we don't have to cover. Certain things that are near water or deal with water on a day-to-day basis are also not covered under flood insurance. So like a pool or a wharf or a pier, like you go fishing off of, these are also not covered under flood insurance because these are in the water already. You're not going to file a claim on your pool because it flooded. Livestock and vehicles are also not covered under flood insurance, because you're supposed to be able to move them away before the flood comes. So like your car, you can drive, and if your car gets flooded, that's auto insurance, not the National Flood Insurance Program. Livestock, again, you're supposed to move that, and that's covered under farm policies, not really flood insurance. Gas tanks are also not covered under flood insurance. I'm not real sure why, but these things are not covered under flood insurance. Pretty low priority on the test. So the next type of insurance we have is inland marine. Inland marine does not mean water. Inland marine means property in transit. The reason why we consider rivers, streams, and oceans marine is because the definition of marine means to be in constant motion. So like rivers continue to run, oceans continue to move, but the definition of marine itself does not mean water. Marine means to be constantly moving. So inland marine insurance is for property in transit, typically on land. The way I think of it is our United States Marine Corps, they go on land, in water. They're always moving around. That's why they're called marine. So don't think inland marine means water. It has nothing to do with water. The first type of inland marine policy is called commercial articles. Commercial articles insurance is for items used to shoot commercials. So for example, musical equipment, cameras, fur coats, everything that people use in shooting videos for musicians or shooting commercials for television. All of that equipment falls under commercial articles, and the reason why that is an inland marine policy is because those type of businesses move from location to location to location. Like musicians will play in one city and then they'll go to a next city. This type of policy, commercial articles, would cover the guitar, the $50,000 camera used to shoot the video, things like that. Inland marine will also cover imports and exports because that stuff's always moving in and out of the country, but it will not cover a warehouse because a warehouse is property insurance. Your test has some weird questions, such as all of the following are covered under an inland marine policy, except imports, exports, cameras, yes, yes, yes. Warehouse, no, because warehouses don't move. The next type of policy is watercraft insurance. This is for boats and yachts that are bigger than what homeowners insurance allows. Homeowners insurance only allows for small boats, so like a regular boat with 50 horsepower inboard motor or 25 horsepower outboard motor max is covered under homeowners. If you have a sailboat that's smaller than 26 feet, that's covered under homeowners insurance. Homeowners insurance will cover small boats, but if you have a larger boat, you need boat owners insurance or yacht insurance. Watercraft insurance will cover the damage to the boat and the liability. It works just like auto insurance, but you have to keep up your boat. Maintenance, wear and tear, inherent vice, regular old things that can go wrong are not covered under the watercraft. This is primarily property insurance and liability if your yacht crashes into somebody else's boat. This is not super important on the test. The biggest thing you want to know is that homeowners insurance only covers small boats. Typically on your test, the smallest boat that you own is covered under homeowners. And here's one more quick fact. If you rent your boat out to other people, these policies do not apply because that would go into business insurance. But if you let somebody borrow your boat or you're just regular old boating, these will apply. Think of watercraft insurance just like auto insurance. If it sounds like it's supposed to be business, that's a business policy. Personal boats, small boats under homeowners, medium-sized boats are boat owners, yachts are really, really big boats. The next policy we're going to talk about is umbrella insurance. And umbrella insurance is pretty cool. Umbrella insurance is excess liability coverage that covers multiple things like businesses, homes, and auto. Umbrella insurance works like this. So I'll draw an umbrella. And let's say that you have your homeowner's insurance, your auto insurance, and you also own a business. The state minimum auto limits for Texas are 30, 60, 25. That's not enough insurance. If you're driving your car and you kill somebody, this insurance not going to be enough. So that person would sue you and take your house, your car, and even come after your business. But if you had an umbrella, after you use your underlying limits, so like you got in a car accident and they already paid out your auto insurance, instead of the person that you hit taking your house or your business, you'd have an extra $1 million of liability insurance over top of that. Umbrellas provide for excess liability insurance above your limits. The standard homeowner's liability is $100,000. So let's say somebody's playing on your deck and they slip and fall, hit their head, and then they drown in your pool. $100,000, not enough to make them go away. But after you use up your homeowner's insurance, then you can go to your umbrella, gives you an extra policy over and above that. Umbrellas are considered blanket insurance because they provide for flexible coverage across multiple lines of insurance. It allows you to cover yourself under your house, auto, business, if you have rental properties and other things like that. This gives you one blanket limit above that. Now, umbrellas insurance do not cover anything except for liability. If your house burns down and it's not enough insurance to rebuild your house, your umbrella won't pay because fire is property insurance. If you murder somebody and you need a bail bond, your umbrella is not going to cover that. Umbrellas are excess liability to protect you from lawsuits, not really felonies or property or anything other than liability insurance. Now, do you remember the limits I just talked about, 30, 60, 25, and 100,000? Those don't work with umbrellas. You can't buy an umbrella with those liability limits. Umbrellas have something similar to a deductible known as an SIR, which stands for Self-Insured Retention Limit. The umbrella's deductible, known as an SIR, Self-Insured Retention Limit, standard in the industry is $250,000. So if you did have that $100,000 homeowners and that person slipped, fell, and drowned in your pool, your homeowners would pay their family $100,000. Then you would have to come out of pocket another $150,000 before your umbrella kicks in. Umbrellas have a $250,000 deductible known as a Self-Insured Retention Limit, SIR. So typically what you do is instead of giving the person $100,000 in liability, you give them $250,000, auto insurance $250,000, business insurance $250,000. You can go higher, but you have to have underlying limits of at least $250,000 to meet your SIR. That way, when you have a claim, your actual umbrella kicks in, and you don't have to come out of pocket any money. Umbrellas are secondary insurance. They don't pay out very often, typically because you really have to kind of kill somebody or have a really big lawsuit against you to tap into that $1 million. If you ever have any assets, like if you own multiple homes or even one house, or if you have a business, or if you have a 16-year-old learning how to drive, you really should purchase an umbrella. They're really cheap. They're around $300 to $500 a year. You can get it cheaper. You can spend more. But umbrellas are excess liability insurance. They work as secondary insurance. They're a blanket policy that covers multiple lines. They do have the SIR of $250,000, and they're really good protection. As an agent, you should sell these to people. An 18-year-old doesn't really need an umbrella, because if they get in a car accident and kill somebody, they can just go bankrupt and get away from that debt. But if you're like 30, 40, 50, and you have assets, you really should purchase umbrella insurance. The next policy we have is a FAIR plan. Most states have FAIR plans, and a FAIR plan is for people who need to buy property insurance, but they can't obtain it in the regular market. This started off in the 1960s during the race riots, when the inner cities were kind of having a lot of riots and people were setting houses on fire. The insurance companies pulled out. So the states developed their own FAIR plan, where if multiple insurance companies pull out of the market, then you can buy insurance through the FAIR plan and it will sell you insurance. In Texas, it's called the Texas FAIR Plan. In other states, it's known as maybe the Joint Underwriting Association. You have to be declined, or there has to be no private insurance available. So you don't see this too often unless it's maybe down by the coast where a property insurance company doesn't want to insure because of hurricanes. It could be in a low population county where there's not enough people to spread out risk. The FAIR plan is state operated and state funded. They also have premiums. So if you have to buy insurance through the FAIR plan, you're going to pay for it as well. The FAIR plans still have underwriting and deductibles just like regular insurance companies. The only difference is they give you an option to buy insurance where you might not have been able to get it because there's no private insurance company in the area. Now we're going to talk about the difference between CPPs and BOPs. A CPP is a commercial package policy. that is on your test. They like to ask you what that stands for. A CPP is a commercial package policy, and a BOP is a business owner's policy. BOPs are going to be for small, low-risk businesses. CPPs are where you get to pick and choose the coverage you want. It's typically for larger businesses or higher risk businesses. A BOP is similar to a homeowner's policy, and that is a test question, because homeowners insurance and BOPs are package policies where you get a whole bunch of coverage for free, and BOPs are cheap. You can insure like a flower shop for $200 a year with a BOP. But a CPP is more like dwelling insurance, where you had to pick and choose your coverages. So commercial package policies tend to be more expensive. So BOPs, business owner policies, are cheap, but they're package policies similar to homeowners. CPPs are pick and choose, like dwelling insurance. They tend to be more expensive. The premiums for each policy is based off the gross sales of the business. The more sales your company has, the more you're going to pay for your commercial insurance. The commercial package policy has 7 parts, and you get to pick which ones you want and which ones you don't. So you don't have to get all of the coverages with a commercial package policy. So like a CPP, you can buy commercial property insurance, and it'll cover your building, your contents, and everything within 100 feet. Let's say you have a restaurant, a big restaurant. You definitely need commercial property insurance to cover your building and all of your stuff, and it'll cover all your stuff within 100 feet. CPPs also include auto insurance. If you don't have a commercial vehicle, you don't have to buy this. If you remember from auto insurance, commercial auto is written as combined single limit, known as CSL. Personal auto was split limit. CPPs, you can add crime insurance. Crime insurance protects you against theft and burglaries and robberies. CPPs can include commercial inland marine, like the commercial articles thing, shooting cameras. Farms can go under CPPs. Boiler and machinery, which is known as equipment breakdown, covers air conditioning units, HVAC units, refrigeration units. Think of like a boiler room in the basement of a big office building, or think of a big air conditioning unit on top of the office building. That's boiler and machinery, known as equipment breakdown. And then CPPs can also have general liability. But again, you don't have to buy them all. Let's say you're a handyman working out of your house. You might just want liability insurance. If you only buy one coverage, that is known as monoline. Monoline is when you only pick one. But if you buy multiple, then you start turning it into a package. BOPs, however, give you all of the coverage. Because remember, BOPs were like homeowners, so BOPs are the package policy automatically together, whereas a commercial package policy, CPP, you have to pick and choose which ones you want. BOPs are for the small businesses. Buildings under 6 stories and less than 100,000 square feet can be covered under a BOP. The business has to have less than $3 million in gross sales, but if it's a contractor, they need to have less than 300,000 gross sales. If they're bigger than this, they go under a commercial package policy. BOPs are for small regular businesses, small contractors, small distributorships. Anything small goes under a BOP. Restaurants with less than 25,000 or 25% beer and wine and 7,500 square feet can fall under a BOP. If the restaurant sells liquor, that needs to go under CPP insurance. BOPs do not cover places of amusement. That would be like a theater or an amusement park. BOPs do not cover playgrounds or anything where people are having fun. This is for the small businesses. BOPs can cover small seasonal businesses, but their seasonal has to be less than 30 days. Essentially, they have to shut down for less than 30 days. So, for example, let's say you're on the beach and the beach only operates 6 months out of the year, that business cannot have a BOP. That would have to go under a CPP. But let's say you shut down just for the month of December. Then maybe your business could get a BOP. You have to be open at least 11 months out of the year to get a BOP. So BOPs are for small businesses. CPPs are for bigger businesses. CPPs, you pick and choose what you want. BOPs give you everything together. BOPs can cover your outdoor signs. If they're attached to your building, they're covered for $1,000. But if they're detached, they're not covered. You'd have to buy sign coverage for that. BOPs cover burglary and robbery, but it doesn't cover employee theft. We called that a fiduciary bond a little bit earlier. Mechanical breakdown was equipment breakdown. That's your HVAC, heating, ventilation, air conditioning, boiler and steamery. This is air conditioning units. BOPs can get employee dishonesty, but you have to buy extra insurance for that. BOPs also cover for utilities because a lot of these businesses rely on like Austin Energy or Reliant Energy. Direct damage is if the utility damages actual products or property in the business. So let's say Austin Energy has a power failure and that breaks my refrigerator in my business. Then that would be direct damage. Time element is known as loss of business income. Time element is if Austin Energy has a power outage and I lose business over time because my business can't run without utilities. So BOPs can cover utility damage to your business. Direct damage is if like power failure breaks my refrigerator. Time element is loss of income because of power failure. Remember, time element is an indirect cause of loss, which means that it pays out over time because you're out of business over time. BOPs typically require your business to have a sprinkler system. Your sprinkler systems can be down for up to 48 hours. So let's say that my sprinklers break. I don't have to call the insurance company if I'm going to have them fixed within 2 days. But if my sprinkler is going to be down longer than 2 days, I have to call my insurance company and get approval to continue coverage. Some insurance companies will cover you, some won't, but typically BOPs require you to have a sprinkler system. And if your sprinkler breaks, it better be up and running within 48 hours. If it's down longer than 48 hours, you will not be covered if something burns down your building. So make sure that if you sell a BOP to somebody, you always ask, do you have a sprinkler? If they don't have a sprinkler, you sell them a CPP. If that small business does have one, you can sell them a BOP, and then just let them know if your sprinklers ever go down, you got 2 days to fix it. These are some more business policies. Builder's risk insurance is for buildings under construction. So like, let's say that you plan to build an office building. You plan out this business, this office building, years in advance. And you buy the builder's risk insurance years in advance. So let's say you're planning a 6-story office building and you want to build it. So you have to hire contractors, a general contractor, electricians. You got to get all this material. So you buy the insurance. And let's say that the contractor drops material off on site and then somehow it catches on fire before the building was ever built. You're covered. Let's say the building is halfway completed and it catches on fire. You're covered. Let's say you're almost done and the building catches on fire. You're still covered. Builder's risk, you insure it for 100% of the completed value, so you're never underinsured during the building of the business. Typically, the owner of the building buys this insurance. Sometimes they'll ask the contractor to buy it. But builder's risk will cover buildings under construction. You're covered within 100 feet of the building, and it's covered up to the completed value of that. Installation floater is what the contractor buys on expensive things that they are installing for you. Let's say you're having this building built and you hire a contractor to install the air conditioning unit. Air conditioning units are very expensive on large buildings. They can run $50,000, $100,000, $500,000 for air conditioning units. So the contractor got the job. He will pick up the AC unit from the manufacturer. The contractor will get it delivered to your building. The contractor will typically hire a crane to pick up the air conditioning unit and place it on top of the building. Then the contractor installs the air conditioning unit. The contractor is responsible for that air conditioning unit the entire time. If it flips over in transit, falls on the highway or something, and it's broke, the contractor is responsible for that $200,000 air conditioning unit, so he has installation coverage to cover him. So the insurance would buy a new AC unit instead of the contractor coming out of pocket. Installation floaters are for things that are being installed. It covers you from the time you pick it up, during delivery, during the installation, unloading, offloading, everything is covered up until the customer accepts the work. Builder's risk and installation floaters both end when the customer accepts it. So you'd install the AC unit or you'd build the building, and then you'd go to the customer and say, hey, I'm done. As long as they sign off, everything's cool, that's when coverage ends. Or 90 days after you finished building it or finished installing it. Or 60 days after somebody starts using it. So these policies would end, let's say you built the building and people started moving in. The day somebody starts moving in is when the 60 days begins. 60 days after you're finished and when they move in, that's when coverage automatically ends. Or 90 days after you're done, but if nobody's been using it, or when the customer accepts the work. Typically, you tell the customer, hey man, I'm done, sign off on this, I'm cool. But if the owner's out of the country or something like that, this coverage will end 90 days later, or once people start moving in, 60 days after they start using it. Builder's risk is for buildings under construction. Installation is for installing stuff. These are property policies, so they include the regular additional coverages, like fire department service charge, debris removal, and all of that type of coverages. These policies, typically you have the contractor buy, but sometimes the owner will buy it just to make sure that they're covered for any of these expensive items. I mean, buildings can be 10, 20, 40, 100 million, $2 billion. You definitely want insurance the entire time you're building that building. The next type of insurance is for shippers, like 18-wheelers, tractor trailers, and things like that. They typically buy two types of policies: annual transit insurance or trip transit insurance. Annual transit will cover the truckers if they're driving year-round. But if the trucker is only going on one trip, then they might buy a trip transit policy. Trip transit policies are cheap. It might cost $50 to go one way. Annual transit might cost, say, $7,000 to cover you the whole year round. Motor truck cargo is what actually covers the truck and the tractor and all that stuff. Annual transit, trip transit cover the contents. Motor truck cargo covers the actual truck. This is not a huge part on your test, so I wouldn't worry too much about it. The next type of policy is known as bailee insurance. A bailee is somebody who has care custody, and control of your property. It's where you drop an item off, they fix it, then they give it back to you. A laundromat or a furrier is considered a bailee. A furrier is somebody who deals with fur coats. So like, let's say you drop your fur coat off at the furrier. They wash it, clean it, fix it. That furrier laundromat is a bailee. Anybody who handles your property like a TV repair shop is considered a bailee. However, if they work on vehicles, that is not a bailee. That is a garage keeper. Your test loves to ask you, all of the following are bailees, except, and the answer is typically garage keeper, because garage keepers work on auto and they have their own separate insurance. Let's say you drop your mink coat off at the laundromat and the laundromat burns down. There's a no benefit to bailee clause, which states that the bailee is not going to be paid for your stuff. Their insurance will pay you, not the bailee, or else I'd go out and open up a laundromat, get a whole bunch of expensive fur coats, burn it down, and get paid for all their stuff and leave. No. Bailees are not paid. There's no benefit to bailee clause. They pay the customer. These insurance policies typically exclude damage to property of others. Most insurance covers damage to property of others up to $2,500, but since bailees are always working on other people's stuff, their bailee insurance does not cover damage to property of others. Contractor's equipment covers bulldozers, backhoes, things with crawler treads. If you don't know what a backhoe is, it's just like a bulldozer. It's got a bucket on the front that picks up dirt, and then it's got a claw bucket in the backhoe that can pick up dirt. If you don't know what a crawler tread is, that's like what cranes use. They have crawler treads like tank treads. Contractor's equipment, also known as mobile equipment, covers contractors' property. This can be written as blanket insurance, to where you don't have to buy separate insurance on all of your contractor's equipment. You can buy one policy covering them all. Accounts receivable insurance is also another policy that covers if your business burns down and people owe you money, they might not pay you because your business burned down. Accounts receivable, typically after 90 days, they'll start paying you the money that people should have paid you for what they owed you. For example, let's say that you have a apartment complex, and the apartment complex burned down, so nobody pays their rent. Accounts receivable insurance could cover the cost of that rent, could also cover the cost of advertising to tell people to pay their rent, things like that. This is relatively low priority on your state test. If you remember, BOPs cover signs up to $1,000 if they're attached, but if you need a bigger sign covered or a detached sign covered, you can buy sign coverage. It'll cover the sign while it's being installed, while it's up, if it breaks. But if you have a bigger sign than $1,000, you have to buy sign insurance. Electronic data covers your business in case your hard drive fails and things like that. Jeweler's block covers jewelry while it's in the showcase. Typically, if you have jeweler's insurance, you need an armed guard to transport the jewelry, or you have to use like a rail car. That's a railroad that has like an armed guard service. Anytime you transport jewelry, you must have it very secure. Do not mail jewelry. If you try to mail jewelry, it is not covered under insurance. The next word is called implied warranties. Implied warranties fall under ocean marine insurance. This is for cargo ships and stuff like that. An implied warranty is a warranty that's not in writing, meaning that if this is not written in the policy, they can still deny your coverage. Ocean insurance must assume that all boats are seaworthy. If the boat doesn't float, you're not covered. They assume that your condition of cargo is decent. If you try to ship rotten bananas, you're not covered. Legality, the boat has to be being used for legal purposes. If you're running guns, selling drugs, you're not covered. If you deviate from voyage too far, so like you're supposed to go to Europe, but you somehow end up down in South America, you're not covered. Implied warranties are warranties not in writing about ocean insurance. There's another part of ocean insurance called P&I, protection and indemnity. You don't have to worry about what that is. Your test just asks you, what does P&I stand for? P&I stands for protection and indemnity. Ocean insurance is similar to boat insurance. It doesn't cover the hull of the boat if you don't maintain it. Ocean insurance is relatively low priority on the test. We have more property insurance. We're almost done. We have about 4 more slides. We have more property insurance. Property insurance will cover things attached to the building or anything that's permanently installed. It covers anything that's within 100 feet of the building. It also has the similar exclusions like everything. Excludes animals, foundation, land, things like that are not covered. This slide's not very important on your test, except that things are covered within 100 feet of your building. That's about the only thing that matters on this slide. This next one is rather important though, and it's a little bit difficult. Business income insurance protects a business if, say, a fire burns them down and they lose income because they're not in business anymore. It has to be a covered peril. So like you can't just go out of business for no reason. It has to be like wind, hail, fire. Something like that has to damage your storefront, and business income will cover your income. So let's say that you have a restaurant. Your location really matters. If it burns down, there is a 72-hour waiting period before you ever start receiving your income. And then if you have extra expense insurance, it can also pay for you to relocate while you're rebuilding this restaurant. So we have 3 policies going on right now. The restaurant burned down, that's property insurance. So you get like $200,000 for the building and the stuff. But since you're out of business, nobody can shop there anymore. So you're losing money every day. Now your business income policy kicks in. But you don't get paid for the first 72 hours. There's always a 3-day waiting period before business income kicks in. Then extra expense insurance will pay for you to relocate extra while you're rebuilding your current location. But it only covers the extra costs. So for example, let's say your rent was $1,000 a month here, and the new place where you're at, your rent is $800. You're not getting any money from extra expense. But let's say at the new location, you had to build out, so you had to get contractors in there to like install some refrigerators and things like that, new tile work. That extra cost is covered. Extra expense will cover the cost to relocate. If your rent's more expensive, it'll cover the higher rent. It'll also cover the build-out costs to make it look like your old location. And then when you rebuild the old location, you can move back. These policies pay out over time. That's why they're known as time element, which is an indirect cause of loss. because it pays out for income. Business income policies are based off the company's gross sales. So what they do is, let me use a different slide here. What they do is you purchase it from a limit, let's say $100,000. So you estimate, the business estimates, that for the first quarter of the year, the first 1/4 of the year, their gross sales are $100,000. If the business is burned down after the 72-hour waiting period, they'll receive 40% of their limit up front. So you try to estimate their gross sales of how much they're going to earn in a quarter. Then when they burn down, they start losing income. After the waiting period, they'll get 40% of their money up front. If they're still out of business on day 31, they get another 40% of their limit. And if they're still out of business on day 90, they get the last 20% of their income. Business income pays out over time, but it tries to front the business a lot of money so that they have money to keep the staff on hand while they're using the extra expense policy to rebuild or relocate or anything like that. Business income is known as time element. You try to guesstimate their gross sales, and then it front loads them the money. The standard limit they use is 40, 80, 100. That means 40% of money on day 1 after the 3-day waiting period, 40% of their money on day 31, so they got an 80% so far. And then if they're still out of business on day 90, they get the last 20%. This question is very common on the test. It's been there for years. If the insured has a business income policy in the amount of $100,000 with the standard 40, 80, 100 limit, they're out of business, but it restores on day 45. How much money did they get? And since they never made it to day 90, they got $80,000, 80% of their limit. Business income front loads them the money in installments, which is known as time element, to make sure that the business is covered so that they can keep their staff on hand. So far we've learned, this is the important one, so far we've learned business income is written as time element, pays out over time. Business income covers loss of income, which is an indirect cause of loss. While the business is being rebuilt, they have to relocate. That's extra expense insurance. That's a part of business income. That'll cover the extra rent and the cost to build out. Business income front loads you your money, 40% on day 1 after the waiting period, another 40% on day 31, and then the last 20% on day 90. If you think they'll need more than 1/4 of income, they can get extended business income. This is on the test, which will give you an extra 30 days of income after that. So instead of it being 90 days, it can be 120 days. In the real world, you can buy longer periods of income, but on the test, extended business income is an extra 30 days. So if I was to insure this restaurant, I'd make sure that they had property insurance to cover the building and their stuff. I'd make sure they have liability insurance in case somebody slips and falls or gets sick. I'd make sure that if they deliver anything, they have auto insurance. I'd make sure that they have workers' compensation on their employees. I'd also make sure the restaurant has business income to give them income if it burns down. And I'd also add extra expense so that they can relocate. Extended business income is pretty cheap, so usually you give them the extra 30 days of income as well. Usually in the real world, they'll use the business's tax returns to figure out how much money these policies will pay out. Now, along with the miscellaneous policies, we've kind of learned these policies work just like every other insurance. They have similar conditions applying to them. On any policy, if you ever want to have an appraisal, you can ask for an appraisal to get the value of the damage for the business. If you can't agree on the appraisal, then your appraiser and the insurance company's appraiser meet with an umpire, and you'll share the cost of an umpire. The umpire only has 15 days to decide how much money to get. If your business burns down or anything happens, you have to give prompt notice to the insurance company, and you have to try to protect your property. If somebody steals from you, you always have to notify the police. All businesses have to allow the insurance companies to inspect their business. Proof of loss, essentially taking pictures of any kind of claim that you had. You have 60 days, also known as 61 days, to give the insurance company proof of loss. All proof of loss is a signed sworn statement. Essentially, this helps cut down on fraud and helps the insurance company make sure they're paying out claims correctly. Inland marine policies, instead of them being replacement cost, inland marine policies cover this stuff on actual cash value. If you want to endorse inland marine up to replacement cost, you can. But remember, most contents, most property, not structure, but like property, is actual cash value. So on your test, they like to ask you what loss valuation does inland marine use. Inland marine is typically actual cash value, which is everything except real property, which is structure. If you ever have a dispute with your insurance company, you have 2 years to sue your insurance company. And we've talked about these things in other chapters. Business policies, you also have to allow the insurance company to audit your premiums. They don't always audit you, but sometimes they do. We've discussed most of this in other chapters.